Great. So it looks like we are live. Welcome, everybody. We're shifting gears a bit from our morning sessions focused on the low interest rate environment and its potential impact on your portfolios. I'm really excited to talk about this next topic. We've seen an exponential rise in impact-oriented and ESG investing over the last decade, which has really been amplified by the past year with the global pandemic. And 2020 really showed us that this style of investing is both here to stay and a critical tool for managing risk across your entire portfolio. Industry leaders, including Larry Fink of BlackRock manages nearly 10 trillion in assets across investment strategies. He continues to stress the importance of sustainability and corporate responsibility to every C-suite across America and the world. So we're lucky today to be joined by two other leaders in this space who continue to push this movement forward. SPSB's own Karen Warsasek. She's our Director of Financial Planning and the leader and expert on our impact-oriented investing initiative. And Just Capital's Martin Whitaker. Martin is the founding CEO of Just Capital, a 501c3, and he's responsible for the overall leadership of the organization. Just Capital is the only independent nonprofit that tracks, analyzes, and engages with large corporations and their investors on how they perform on the public's priorities. So Just's research, rankings, indexes, and data-driven tools really empower all market participants, including us, to help build a more just economy. So we're going to get into that here in a little bit, but what I wanted to do is actually start off with a poll. And I'm going to add it real quick. So the question is really, can you define ESG investing? And the answers will be yes or no, and then what a third answer is, and if you don't want to, we don't have it available, but is maybe, because we know through a lot of our client conversations that there's so many acronyms being tossed around that it can get confusing pretty quickly.
And did you launch the poll, Walt?
Oh, yes. I think it was launched. Sorry. I'll launch it again. So I'm launching it right now. Hopefully everyone can see it. I think we got a couple answers in on that initial one, and I closed it down early. So I think in general, Karen and Martin, I know we've had a bunch of conversations as we were preparing for this and over our history of talking about this space. But Karen, I'll end this poll, and with some of the results, we got 13 each, or 26 in general. 50% said yes, 50% said no. So I think starting out at a higher level, defining what ESG stands for, and then really, what does impact-oriented investing mean to you?
Yeah, I think that's a great place to start. And the results, Walt, don't really surprise me. It is a bit of what we see in the field when we're out talking with people, and it's still a very new area to understand. But where we start in our conversations with our clients is really thinking about the highest level of putting capital to work for good. And if you think about the Global Impact Investment Network, or otherwise known as GIN, they've got a definition that is really kind of wraps up impact investing as with intentionality. So I'm actually trying to make investments to generate positive, measurable social and environmental impact without giving up financial return. And so many of us, as we listened to the talks earlier today, a lot of that is traditional market rate return kinds of goals. And so we're not sacrificing that to actually think about an investment that we can make for good. So another way we kind of think about this is purpose capital. So what, in addition to financial return, is my money doing in the community for people, for the environment? And I think that starts to help break down what kinds of investments are available to help advance some of the environmental, social, and governance initiatives, which are what those three letters stand for. And so as we kind of come out, and we'll get into this conversation today and thinking about, especially this past year with the pandemic, each of those carry different weights of importance for individuals in the community and employees and owners of corporations.
Yeah, and I think Martin, one of the ways what Karen mentions is for each individual, it feels a bit different. Everyone has different interests, and I think one of the very unique things about Just Capital and what you are doing is you're polling America to actually find out what is important to them. So yeah, I wonder if you could maybe introduce us to how you're doing things.
Well, thanks, Walt, and it's great to be here. Great to be with you guys and with Karen. I mean, we're grateful for the chance to talk about what we do and about the space overall. I've been in this area of ESG for 25 years now. It wasn't always called ESG, but more or less that is the sort of the header under which so many other things have happened. I'm not surprised it's basically 50-50. There is no single definition. This is part of the problem, but I also think it's part of the opportunity. I would say anybody in the investing world, whether you're an advisor, you're looking to invest capital, should think about this as just a general theme that will allow you to pursue competitive risk-adjusted returns across all asset classes in a way that takes into account non-traditional drivers of performance. That's typically, ESG started as a sort of exclusionary approach where you filtered out so-called sin stocks that were, companies that were doing things that you just didn't agree with. You didn't really think too much about the performance implications of it. And I'm thinking all the way back to, the anti-apartheid movement, which is really where sort of modern day negative screening began, but since expanded to include a whole bunch of other stocks related to more recently fossil fuels, gambling, things like that. Now, that's a category of investing which works for many, but not for everybody. And ESG is typically now seen as a way to think about environmental, social, and governance related risk and performance factors, which traditionally are not priced in. The risks associated with, for example, climate change are gradually being understood and gradually being priced in to the cost of capital, to company share price, gradually being understood as an investment factor, and I'm just choosing that as one issue. And so a smart investor would say, okay, well, if I'm looking over the long term, this is a factor that I want to think about when I'm investing. And you could say the same thing about how a company engages its workforce. Now, for Just Capital, to answer your question, I'm sorry to be so long-winded about this, but you can tell that it means a great deal to me. For Just Capital, we began with the point of view that we didn't want to have a fixed set of issues that we felt were important. And the way we derive the issues that go into our approach is by just going out and talking to people. We wanted to have, in a sense, a nationwide set of criteria which were important to a representative group of Americans. And we've polled, over the 7 years we've been around, over 100,000 Americans, all different backgrounds and types and locations, etc. And we built up a very clear sort of blueprint for how ordinary Americans want business to behave, what issues people care about, what people want companies to do more of and less of. And that's what drives our approach. When we talk about just investing, that's it. And I'll give you the takeaway right now, which is the headline is that most people would tend to agree that how a company treats its workers, its customers, the communities where it operates, the environment, and of course its investors as well, that's a recipe for a just company and a great company going forward. So that's our approach.
Yeah, it's interesting. I wanted to add to that, Martin, because I think you hit on exactly what was really veiled so much, a lot of veiling for some of those issues for so many people up until last year. It seemed hard to touch or hard to access. And so when we saw what we saw after the pandemic, and you have a large part of our workforce that represent some of the inequalities that we're seeing that are growing the wealth gap, right? So in the caretaking workforce, in the education, public education workforce, and in the bottom parts of corporate America, and largely having to kind of suddenly go home and shut down the economy. And the ripple effects on that touched everybody in one way or another, right? And so that was really unprecedented in that way. And I think kind of what your methodology has really brought to light is that, oh, actually, that's what the investing for environmental or climate action, and that's how doing that can help sustain a business. And so to your point about taking undue risk related to environment, or risks that you take on as an owner of a company throughout your employee space, and then also who you're partnering with in your supply chain, we started to see a lot of the breakdowns of that last year. And so I think it's a good segue to kind of think about this concept of stakeholder capitalism, which is really new. So as you mentioned, going back to the anti-apartheid movement, and I've been involved in mission-oriented, and that's how I kind of came to kind of grow up in this part of the investment space, is back 15 years ago, when it really was about negative, it was exclusionary. When you start to exclude certain assets, you are very much making a compromise in return, if that isn't where the market is going generally, right? And so a lot of work has been done to kind of flip that script and become more of an engagement model. How can we actually help a company create programs, create new innovations that actually obviate the need for exclusion, right? And what you have done with Just Capital, I think it's a great kind of segue to think about stakeholder capitalism in that way. Other than just the shareholder, and there's another poll question I did think would be really interesting to get feedback on, and this would be a good point to do it. And then I'll kick it over to you, Martin, to kind of talk a little bit about what Just has done with kind of identifying some of the corporate stewardship and governance issues, especially coming out of the pandemic. And so this poll question is, and I'll launch this now, but do you believe corporations have a responsibility beyond just you as a shareholder? Yes, or in some instances, or no, not at all. And this gets back to kind of what Walt started the conversation with around Larry Fink and BlackRock's leadership, but I'd be curious. So the poll is open, and we'll give you a second to answer that. Okay. And I think I did that wrong. Possibly need more time. So anyway, I think, Martin, this is a really complicated nuance now that's already, when you think about impact investing and ESG investing, getting some legs, getting some attraction in the marketplace. Now adding another layer of complexity around this idea of stakeholder capitalism. Talk to us a little bit about that Just Capital's approach and the methodology in identifying who the stakeholders now are.
Yeah, exactly. So, well, to respond directly, our approach begins with our public opinion research, and we conduct that throughout the year, and we identify the specific issues through focus groups and through different types of qualitative and quantitative polling to within each of those 5 stakeholder categories. And when you go out and you know, we've got many years of experience doing this now, and talk about the role of corporations in society, almost everything that comes back in terms of the issues that matter fall into one of those 5 categories that I mentioned. The relationship between a company and its workers, its customers, the communities, its impact on the environment, and then how well governed is it and how does it look after its shareholders. So it's not as though shareholders are forgotten. On the contrary, they're a crucial part of the stakeholder model. The essential point, though, is that by creating value for all of those stakeholders, you build a successful company. And, you know, any business leader worth their salt knows that. I'm sure the folks who built, you know, your company, SBSB, like you invest in your people, you look after your customers, you know, and so on and so forth. So it's really, I think, an essential tenet. Now, how you measure that value creation process, over what period of time does value get created for shareholders? Oh, those are all the key questions. So we're not talking about some radical new model. This is about, you know, I'm a capitalist. I care about markets. Just was founded because we believe that markets acting out of enlightened self-interest are really essential to addressing societal challenges. And that's actually a great business model. So anyway, so we bring it all back to a company's overall performance. Throughout the course of the year, though, the public opinion work that we do identifies underneath each one of those 5 categories specific things. So under the worker category, it was, you know, it would be, does a company pay a fair wage? How does it address diversity, equity, and inclusion within its workforce? How does it train and provide upward mobility for its employees? Is it providing a living wage? What kind of benefits does it offer? So it's very concrete, tangible, sort of kitchen table, old school, you know, things that just matter when you're building a good company. And so all of those factors, we essentially take the Russell 1000 companies and we track and analyze and rank them head to head on each of those things. And if you were to go to justcapital.com, you would see how any company against any of its industry peers or any group of companies you want to compare it to stack up on each of those issues. So it's really very simple. And we take that and use that to drive investment strategies. That's part of Just Capital's mission, is to try and influence capital in a just direction. So that leads us into the investment world, and how can we provide access for investors to companies that do well on all of those things. And the reason why that's interesting to investors, of course, is it drives superior performance. At the end of the day, this is about better risk-adjusted performance. And we saw that in glorious technicolor in 2020 when COVID and racial equity and economic, the closing of the economy and the reopening of the economy pushed business to the limit and reminded everybody of the importance of the human element of business. And what we found is that companies that did well on looking after their workers, for example, during 2020, on our criteria, outperformed their peers by a mile. So those are the kinds of, that's how our approach begins and how it segues into the investment world.
Yeah.
Yeah.
It's
Thanks,
really
Martin.
great.
So Karen, I was just going to jump in and say the polling results came in, and it was fascinating to see every single 100% of the vote was yes, or in some circumstances.
That's incredible.
You believe
that really is
corporations
incredible.
should- yeah.
Maybe I was very
I'd say
convincing in my argument.
Yeah, I mean,
I think
no
you
room for
touched
error
on
there.
that. So important.
And so I'd say, Martin, So Karen, I was going to say you just released a white paper, and it really hits on what Martin was talking about in terms of what 2020 you really saw a clear differential between how some companies performed that treated their stakeholders well versus others. Can you bring up or talk about a few examples of corporations during this pandemic when you were from your white paper there?
Yeah, no, it's interesting. As Martin was talking about stakeholder capitalism, a lot of the work that I saw and worked on with clients last year that really supports what's written in that paper, well, has a lot to do with how this notion of people and how people were affected. And in specific, we all identify with a livelihood, right? We want to feel needed and valued and be giving back to society. It's rare that people don't want some of those things, right? It's part of Maslow's hierarchy. And so what we saw during the pandemic is certain needs not being met, right? You saw massive, all the food insecurity ballooning, and especially among our public school children, which are 90% of the children in America educated in that format. So, and the production that is lost every single week that the public school system is shut down is about $10 billion. So you can kind of extrapolate that to, again, this notion of what's a corporation's role in trying to contribute in some way to this idea of workforce mobility, which I think is the big theme around and even represented very, very well in Just Capital's tracker, is how corporations were pivoting so quickly to meet the demands of a new work from home environment for those that could work from home. Now, there are a lot that could not, right? So when you're thinking about teachers and caregivers and the hospitality services and restaurants and travel, parking lot that for a minute, that became kind of our biggest detractors to how people were suffering. So we all didn't experience COVID in the same way, and the pandemic in the very same way. And so some corporations that stepped up really well were the ones, and in the survey, were making accommodations and even providing some caregiving support for children, helping to find, tutors and temporary teachers for workers that did need to be at work, could not work from home, and even increasing and being more flexible as to the hours that companies worked. And we have the luxury, the three of us, to work in an industry that largely looks and feels like a tech industry, right? We can do what we do from anywhere. And we don't have to see each other in person. While it would be nice again someday, we don't have to. And there's so many, and if you're in hospitality, you're shut down. And so how we respond, how a corporation also comes to the community and helps to participate in programs that meet the needs of those workers that are shut down, also scored very high and ranked very high. Another company that I like, and I think it's one, Martin, that you follow as well, and as part of your tracker, is a company like PayPal, right? So you take a company like PayPal who has identified that actually we're employing some workers that don't actually have access to the capital markets or mainstream banking. So not only the demographic outbound that you're trying to profit from as an organization, but also you're employing them. So how do I actually create programs of financial inclusion, which is one of the kind of inequities that is very much exposed during the pandemic? How do I create programs as a for-profit corporation that also include community members, but my own workforce, so that they can bank, right? The inequality in the bank and who has access to traditional banking is a staggering number, and a lot of the number lives in single-headed female households and people of color, right? And those, and when you look at a recent study, Harvard did a study, kind of, Martin, to your point about what were those emerging themes that not just people who identify as environmental, social, or governance investors, but just all people, all American people, that they want to see workplace safety conditions because they're operating from the lens of an employee. Well, I don't want to show up to work and be kind of feeling that my health or safety is at risk because there's this pandemic going on. How is my company going to support me so I stay healthy and I'm more productive when this ends, right? And the idea is that something ends, but what this has been informative of is how companies now can be, how they might look in the future. And Martin and I were talking earlier today about, work mobility is here to stay in some form or another. And even companies that are companies that don't traditionally can't operate like us and work from home the way that we do are finding ways, even in hospitality, to create new flexible arrangements around work. And I think that's here to stay and benefits mothers, children, parents, and everybody that has to kind of be employed or be at the mercy of someone else who's employed will be dependent on that. But what it has done, and I think even what I loved about Jeff Porter, the CIO, mentioned earlier, which I thought was fantastic, is kind of highlighting the income inequality, and this is a huge theme in treatment of workers and wage and equity, pay equity among your workforce. And I think a lot of us believe that there has to be attention paid to that throughout a company's employee ranks. And when you look at the number that Jeff presented, since 1980, the bottom 90% of Americans have stayed flat, right? And so in wages and income. And so that, as you can imagine, where, those lines, the top 10% then exponentially are better off. And so that's an interesting theme that I think is really perpetuating what we're seeing today in policymaking and in corporate behavior.
If I could just add to that, we saw last week Walmart raised wages, stock got pounded. Classic sort of market reaction. If you look at other similar wage increases, Target, Walmart itself, and Amazon, Costco in the past, stock always rebounds and it always goes on a tear after. Walmart did that not as a one-off. This is part of a 5-year program to invest in its frontline workers. Where it's done that effectively, it's seen same-store sales increase substantially and retention go up by double-digit percentage points. Staff retention, which is sort of the key to upward mobility. So they write about this extensively. So the point is that a company that invests in its workforce like that, sure, there's going to be some reaction, because the knee-jerk response is, well, that's a cost now, and it wiped, I don't know, billions off of their market cap. I think the stock dropped 9%. I see that as an opportunity, because I see that as a company that says, okay, we're not in a race to the bottom here. We're investing in our number one asset, which is our people, and that's going to have a long-term return. So if I'm focused on just investing, if I believe that companies have a responsibility beyond shareholders, or even if I believe that actually investing in my people is the best way to serve my shareholders, which PayPal, as Karen mentioned, has done extraordinarily well, that's a great investment strategy. That's a great use of capital. So that's again, this sort of idea of a myth of ESG or just investing is somehow that something we have to give up. Either the money's going to shareholders or it's going to my workers. It's a zero-sum game. That, I'm afraid, we need to confine to the dustbin of history, because it's just not reflective of where we are today.
That's right. And it's funny, on the employee, you brought up wages. Another phenomenal stat is that they tied to worker engagement and attendance for the lowest wage paid workers, when their wages were increased, doubled. So to your point on productivity, you have less people calling in sick, less people because they have more at risk, right? So there's more at risk. They now feel more valued for the work that they're doing, or more fairly valued. And that's an interesting kind of measure of return on that public company's stock, if your workforce is not turning over and they're actually attending work to do their jobs.
When people are happier and more engaged, they're going to be better employees in themselves personally, and the company's going to benefit. It's not rocket science. And I also think societally, there are libraries full of studies that show how investing in workers, especially when people can get ahead, when they can put food on the table and have a sense of dignity at work, there's knock-on ripple effects on education, for the family unit, for community, on health, and other issues. So that to me is just a win-win, and I think that's really at the bullseye of what we're trying to do at Just Capital.
Yeah, no, I mean, it's amazing work being done across C-suites in America and what we've seen. And I think it brings back the big question mark, which is how, from our investors, from our clients, is how do you define success in this space? There's the quantitative success, there's the returns, there's the Walmart that drops 8-9% off of that result, but it's taking that longer term view and maybe tying in some qualitative alpha. So kind of a two-part question, but Martin, one for you, I'm sure collecting this data isn't easy. So really, how do you define success of the company in that aspect? And then Karen, down the line, for us, for what we do in our portfolios, how do you incorporate that qualitative success in terms of the quantitative?
And Martin, I can pull up your slides if you'd like, if that is a good time to jump into that or not.
Sure, if you don't mind, and then I can just I can answer that question just by pointing to a little bit of data, because I think to your question, Walt, success is defined in a couple of different dimensions. If you don't mind, just moving forward, I'll quickly go through this because I think it's important. But the bottom line is going to be the answer to your question. It's clear from our survey work that the vast majority of people in the country believe that doing right by stakeholders is what just companies should do, and this is a perfect opportunity to do that. That's what this slide says. And then if you go forward, we always talk about this country being so divided. Actually, in our polling, we see a ton of agreement, which is actually one of the things that gives me a huge amount of optimism. If you go forward, you'll see, there you go. So, we see, substantial agreement, and this is across political lines as well as, age, economic bracket, location, etc. The vast majority of people believe that we have structural problems in the economy. Most people, believe that, there's millions of Americans being left behind, and that, people are much more aware of what just company behavior looks like. If you go forward, we talk about performance. I mentioned this before, paying a living wage, lifting wages. That idea is just a myth. If you look at the chart, you'll see, companies that actually in that red line, those are the top 20% of companies in our universe, the companies that do best on paying a living wage, which is a measure of how wage levels compare to local county level living wage levels. Those companies outperform their peers, especially if since we hit the pandemic. That premium, that outperformance premium, has grown since then, which is kind of really interesting, because now you're looking at companies that are really investing in their workers when it matters the most. If you go forward one more, we come to this old chestnut, that being just costs companies money and lowers profits. It certainly is an allocation of capital, but if you look at the data, what you find is that actually companies that invest in their workforce tend to do better. And in this measure, we have return on equity, again, by quintile. Forward one more, we deal with another myth, which is you can't have impact and superior returns. And we've shown that time and again just turns out to be a great myth. If you go forward, actually, this is the flagship index of Just Capital against the Russell 1000 benchmark. And this is basically the best companies in every sector. So there's no sector effects here. This is just, a pure signal, we think, of stakeholder performance. One more would be our Just 100, which is the top 100 companies across every sector. And then the bottom line, the punchline, which is to your question on success, Walt, if you go forward one more, is right here, which is these companies not only do better financially, which is obviously a big measure of success, they also pay their people more money, do better across a whole range of pay equity assessments. They're more generous philanthropically in their communities where they operate. They have a lower environmental impacts. They have more women on their boards, and so on and so forth. So every one of the things that we measure comes down to a quantifiable score, and we can track progress in concrete ways year on year. That's what we do. And on the right side there, you see the top companies, and the number one is Microsoft overall. So success to us, to answer your question, is very straightforward. Obviously, it's financial success, but it's also moving the needle on those underlying issues.
Yeah.
Yeah, and I think that's the big differentiator is, I know you mentioned your website earlier, but justcapital.com, to go on there, the transparency is incredible, and you can really see what you're doing in terms of that qualitative. So Karen, for us, and me and you have had numerous conversations about how do we track, how do we aggregate all of this good that this style of investing is doing.
Yeah. It's fun. It's funny. We're in a little bit of a different seat than Martin, right? And so what we're charged with is, our clients come to us, and you don't want just one company name or piece of advice. We want to put an entire set of values in action expressed in a portfolio of companies and ideas. And that's the challenge, right? And so as we put together ideas, we think about the space really as, and one of the things I'll pull up here is, because the thing that is becoming a little bit more of some common language in really globally is a set of goals that the United Nations came together in agreement on, around 17 different goals. And so I want to start here because this really helps connect a family or an individual's values to the money, right? So how do I actually then think about one of these goals? And we've talked a lot about education here today. So goal number 4 by the UN Sustainable Development Goals is quality education. So how can I actually put my capital to work in advancing that goal? And then there's several here on climate. There's several here on no poverty. And so the poverty we've talked a lot about in the context of the workforce and inequality and wage gap, and not just wage gap, but wealth gaps, right? And so we're trying to put together a holistic portfolio. And one of the ways that we do that is really looking, we do rely on the public markets and private investments, but also there is trillions of capital in the public markets that can be leveraged for purpose, for good. And so that's actually an area where, and let me pull up this slide here. If we look at our how we integrate a lot of these themes, is we'll put together a core portfolio, no different than philosophically, not a different investment philosophy than any other investment program you would work with us on, right? What we're just adding is that third dimension of environment, social governance, or other impact themes as kind of presented in that Sustainable Development Goals chart. And so in the core there, and as everyone participating on this call knows, we're an open, we use managers, best-in-class managers that we've identified, that we bring to you and put the portfolios together through that model. And the core might include, for example, U.S. large cap equities. So a lot of the companies that Martin's been talking about that they're tracking and that they're evaluating and ranking in their methodology, live inside of that part of the portfolio. And then we'll look at, I have a client that, for example, is actively involved in kind of environmental and water, clean water, and particularly in this region. We'll look at expressing that particular value and interest in a bespoke way through what you see here on this chart as a satellite manager. And so we'll look at environmental leanings to kind of round out that portfolio in that example. But that could be a social, it could be a governance. One of the interesting things that you end up with is you don't just accomplish one goal when you set out to put money in motion for good. Like Martin said, you're actually touching many aspects of how a company is profitable, but how it also exists in the community. So, for example, companies that might rank really, really high in just methodology, we also want to look through to that and say, well, who are they partnering with and how are they behaving? So if you think about an Amazon, for example, and they're, who are their distributors, their supply chain partners and packaging partners, and are they leaving carbon footprints? Are they treating their workers well? How are they governing their enterprises? Right. So all of that gets baked into this approach, and that's what I find so wonderful about how we implement is we have the luxury of working with lots of different partners to bring the best of that to you. And so in here, you can see what changes on the right is you have that fundamental analysis, which is what Walt does day in and day out as a portfolio manager, is evaluating those financial metrics. And then we're adding that third dimension, the layers of impact measurements and ESG measurements that Martin and I have been talking about. And then you have this kind of new return objective, right? And so a lot of clients have come to me in the past and so I just don't want to do bad, right? I want to make sure I'm not contributing to something that's really, really hurting. And a really good example of that is sometimes people are unwitting as to their investments in private prisons. And then on the other side, they are have a belief around social justice and racial equity. And that conversation has to be had to kind of understand the relationship between that investment and this value and this goal around equity, as to kind of make that come alive for you. And so that's what I love about our approach, and we try to do that with all the other tax-minded strategies that we would do in any scenario, whether you are have a bias towards ESG investing or not. As a tax and planning firm, we don't do any of this in ignorance of those other goals. So it's really been such a wonderful time kind of after now when you see the flow of funds, and Walt and I were talking about this, is there the FOMO? Is that kind of taking hold? Is this a trend? Are people jumping in because everybody else is doing it? A little bit of kind of what's happening in cryptocurrency and in some respects. But in this case, that isn't my belief. Martin and I have been in this field for a very long time, and the trend line is continuing to direction because of a lot of millennials, next generation women who are wealth owners and that are expressing and raising their hand and saying, hey, actually, I care about workplace conditions. I care about, how education inequality is contributing to the economy or not, right? And so kind of raising their hand and wanting to vote with their dollar, which is, as we all know, the most kind of powerful voice that we have in this work. So, Martin, I'll let you add to any of that, but we'll open up for questions here in a few.
No, I think you summarized it perfectly. I think the wider context is what you just said. I've always felt I come from an investing background, even though just as a nonprofit. And you must always look at ESG strategies in the context of your overall investment goals, tax objectives, long-term wealth transfer, intergenerational, wealth protection, et cetera, all of those things. But the good news is you can do that now. ESG is I think going to go away probably, 10 years from now, but we won't call it ESG. It'll just be smart investing. I think if we look at many of the ESG factors as being core parameters for understanding what makes a business or a portfolio successful, it's going to be embedded right in there. So there shouldn't be any kind of FOMO. To me, this is, how do I think about my long-term investment objectives, things that impinge on that, and design with that in mind. So that's always been my approach when I was a founding partner at an impact investing firm, and that's the way we took it. So I think you've got it exactly right, and bringing that all together in one comprehensive approach is really the trick.
That's right.
Yeah, no,
and I think
absolutely. And as Karen and Martin both hit on, I think it makes our job, Karen and I's job, that much more important. It's really making sure it's a two-step process where the first step is finding out what's important to you, what values make you tick, what you want to match your investments with. And then the second one is, okay, what funds can we use and do we feel confident with? Because every fund family at this point has released a strategy in this space to try to capture, take advantage of some of this asset growth. And for us, it's really the due diligence that we do is go underneath the hood, figure out what this fund offers, and make sure that it matches your convictions. Mm-hmm. So any concluding thoughts before we open it up for Q&A, Karen and Martin?
Yeah, I did want to add one thing, because we kind of skimmed the surface on it, but a little bit about, and you just reminded me of this, but the proliferation of a lot of new products, right? So there are many new actors, and that have lots of existing investment products that are adding this to their suite of products, and it's good. It's good to see that momentum. The challenge will be for the investor is really needing to lean on good advice from us, advice from folks like Martin, as to, how do I impact that new offering? And does that actually make sense? Or is it greenwashing? And it's a term, a lot of us have heard in the field. Are they just saying that they're doing one thing and then they're really doing another? And we can help dissect that with you. And so our goal, as Walt said, is really to look under the hood, see what's actually happening. That impact measure, that third dimension, is okay. Are we actually seeing an increased number of living wages? Are we seeing more board seats to diverse candidates? Are we seeing more of a pipeline in leadership that looks more diverse? All of those things. The next generation poll, an overwhelming 80% on governance being kind of the number one of the ESG in a go forward. So there's really this connection between, individuals, especially in that demographic, not trusting corporations is I think the intimation there is, okay, that we've got to earn trust and faith back that we're doing right by all stakeholders. And so that G is surfacing as the number one impact goal, ESG goal of some of the newer investors that we've been working with. And so Martin, go ahead.
I'll just say, a couple of things real quick. One, I think the change in administration, forget about your politics, but I think the administration is going to remove some of the barriers to ESG investing. So I would expect to see that happen. To your point, Karen, I think reporting on ESG performance so that investors know that their money's actually having a difference and that there's something going on under the hood is really important. I would be as disciplined and rigorous and insistent on ESG reporting as I would be on your financial reporting. I think that's going to be a big competitive advantage going forward.
Mm-hmm. Could not agree more. Yeah.
Well, great. No, this is a great conversation. We've had a couple questions trickle in. So the first one is, although ESG goals are laudable, the three components together may dilute a specific investor's focus on particular areas of concern. So for example, are there opportunities to invest specifically in funds that are innovating to develop solutions to climate change with less emphasis on the other components? So Karen, I think this may speak to what we refer to as the E, the S. We lean towards certain objectives there.
That's right. And so it's a great question, because it's all of us have a pull to one idea or one set of outcomes than another. So one takes the front seat, right? And what I was mentioning before is you can certainly, there are many investments available today that are that we'll call climate pure, climate action funds and solutions. And it's not to say that underneath that there aren't other things that organization or that fund might be doing. For example, the primary focus might be climate or environment and renewable energies. Certainly all those things can be packaged, and there are many of those solutions. But there might be other things that you benefit from indirectly, and that's that cascading effect of goal strategy effect, and that who are the individuals employed to meet that goal, right? What are the wage and other benefits and standards? Who are the suppliers to all of the initiatives of that particular goal? And that's that cascading effect that I was talking about earlier. So, but you certainly can have a who's taking first. Which goal is, if it's climate and energy and environment, might be the front seat. And then there might be these other things that you might not be focused on, but they're nice. They're going to be a nice side benefit.
Yeah, I would agree. There are the answer is an emphatic yes. There are many thematic investment approaches, especially around environment and climate, which is the example. But there are an increasing number of funds that are very focused on individual themes of gender, racial equity, companies that create good jobs. So there's lots of thematic approaches, and climate, there's plenty to choose from. They're some of the best performing funds that I've seen. Indices are very focused on that. So you can get thematic exposure in lots of different ways now.
And talk about one thing to add to that with the climate is, Martin touched on it, to not be political, but now more than ever, we're in a very promotive policymaking environment for environmental, and we just had, Larry Fink come out, in fact, and kind of have a goal around net zero carbon emissions. And so we have an administration that's supportive and has signed back onto the Paris Treaty. So those are all under the umbrella of those sustainable development goals, that chart I showed earlier. And so very much there's, in fact, I wouldn't be surprised if I see that particular sector kind of emerging with new product, even beyond where it's at already, but performing in a way due to policy supports, because a lot of things don't happen if you've got big machines of capital in your way.
Yeah, and you've really seen it. If you look at just clean energy stocks, for instance, you saw it's the beauty of the markets. They were forward-looking. Always markets are forward-looking, and we saw massive appreciation in these since the Biden administration got elected in November up until January when they took over. So definitely, we are, as Karen mentioned and Martin mentioned, we are looking at the whole universe. So we have strategies that for investors that just want the full ESG framework. We have strategies for investors that want the specific focus, want the focus on social, or want to focus on the environment. So you can definitely reach out to your SBSB teams there. So one other question that came in related to just capital is, the partnership. As Karen mentioned before, why Martin's joining us today and why we've done so much work with Martin is we employ the Goldman Sachs U.S. Just Large Cap Index as our core holding for U.S. stocks and across these strategies. So Martin, can you just give a little bit of history into your working relationship with Goldman Sachs and how your data filters into their process?
Yeah, of course. So I showed actually in one of my slides the performance of the just it's called our large cap diversified index, the JOLCD. So on one of the slides, it's basically the top 50% of companies in every gig sector with market cap weighted. It's just an index that we launched on a live basis in November 2016. And it was always our intention to license that index to an asset management partner because the more assets we have under influence at Just Capital with our work, the more influential we can be as a nonprofit. And so, we talked to lots of different groups, and we formed a great relationship with Goldman Sachs. They've been a phenomenal partner, and they've licensed that index. They formed the Just ETF. It launched on the New York Stock Exchange. We rang the opening bell in June 2018, and that product has been in the market since then. And I know it's managed by Goldman, and we hope it's the first of many products. And we have other products in the market as well with other partners, but that's a story on that one. And it's obviously based on our rankings, and really that's really the primary driver of the underlying securities. It's our methodology as I've described it and as published on our website. So there's not a lot. It's pretty transparent. It is what it is, and what you're getting is a very broad-based ETF, covers lots of different issues. You're getting the best companies in every sector by our methodology.
Mm-hmm. And it's really a testament to there's no longer really illusion.
Sorry, Karen, go ahead. I got a little delay, I think.
Yeah, I was going to just say it's really a testament. One of the reasons we include it in our approved funds platform is it is a testament to the forward-looking approach of engagement strategies. Instead of excluding bad actors, kind of finding who the good actors are, what they're doing to improve their systems that are in sectors you should have exposure to or you should be participating in for other performing reasons. And that's kind of our belief and why we think that it makes really, really good sense in a portfolio.
Yeah, and I know we're looking forward for more of those indices to become available, Martin. So we'll stay in close contact there. So we're out of time on day number 1 for the SBSB Onward Symposium. It's been fun. The virtual, I wish we were all in person. I miss the food, the drinks, and the camaraderie, but we really hope to see everyone tomorrow. We hope you enjoyed it. And Karen, Martin, thank you so much for being a part of this. Again, reach out to your SBSB team if you want more information or want to continue the discussion.
Thank you.
Thanks, Walt. My pleasure. Appreciate it.
Bye, everyone. Bye.